It's important to note that in the period 2000 to 2025, the gold price has gone from $250 an ounce to almost $3,500 an ounce. It's up 12-fold. When people ask me when gold's going to move, and you've asked me that, I've said it's going to move in 2000, which is done. For me, I believe that the next 10 years is going to be very good for gold. The gold price is up 12-fold in 25 years, and ownership of gold in the U.S. still constitutes less than 0.5% of total savings and investment assets in the United States, where the 4-decade mean is 2%. I believe that gold's market share in this market will at least revert to mean, which means that demand for gold should grow 4-fold, which is what I believe is going to happen. I have no idea what that will do to the price, but I suspect it will be attractive.
Gold has risen 12-fold from $250 to nearly $3,500 per ounce between 2020 and 25. Despite this, gold still makes up less than 0.5% of U.S. savings and investments, well below the 2% long-term average. The speaker believes that as gold ownership returns to its historical norm, demand could quadruple, likely pushing prices even higher over the next decade. While some insist on only owning physical gold, the speaker, Rick Rule, a prominent investor, entrepreneur, and financial commentator, sees little difference between that and high-quality gold surrogates, and owns both. In a typical precious metals bull market, physical gold moves first, followed by top-tier gold stocks, and then gradually lower-tier producers, developers, and explorers. He believes we're now at the stage where leadership is shifting from bullion to top gold stocks, which will benefit from rising margins and free cash flow. An upcoming boot camp will cover the best producers and royalty or streaming firms, followed by a later one on smaller, faster-moving mining stocks. Rick Rule mentions, the upcoming gold investing boot camp is an intense 8-hour session packed with more information than most can absorb in one sitting, but attendees will have access to transcripts for a year. It's not for casual learners, it's a deep dive for serious investors. The faculty includes seasoned experts like John Hathaway, Adrien, and geologist Joe Mazumdar. The $99 fee comes with a full money-back guarantee if unsatisfied. To truly benefit, participants must engage fully, replay sessions, and join discussion groups to compare insights and deepen understanding. As we present clips from the video, please like this video, subscribe to the channel, and turn on the notifications bell to be instantly notified every time we upload a video. Thanks for the support and enjoy the video.
Well, I would argue a little bit about your first statement. I don't personally see an awful lot of qualitative difference between owning physical gold and the physical gold surrogates. I understand some people say if you can't touch it, you don't own it. I respect that. But I'm less concerned about how somebody owns physical gold. But I think you have to own physical gold. In my experience, you visualize a precious metals bull market like you visualize a circus master's whip. The front of the whip and the whip handle is the physical gold. It moves first. Afterwards, the very best gold stocks move, and they're just starting to move now. After that, the lower quality, the intermediate, the high quality junior producers move. Then the developers move, then the explorers move. That's the way it works. And you can follow that continuum, which has been proven in history. I operate because we see now that the probability that gold at least maintains its current price, but probably increases, means that the senior producers are going to enjoy greatly increased margins and free cash flow. And the market has begun to notice this and will continue to notice it. So we believe that we're in the part of the bull market where leadership changes from the bullion to the highest quality gold stocks. The upcoming boot camp this Saturday will deal with the very high quality gold stocks. Not just, although focused on, the biggest and best royalty and streaming companies and producers, but also the very, very, very high-quality smaller companies that are likely either to move with this bull market or be taken over by other companies. The subsequent boot camp, 90 days from now, encompass the rest of the gold miners. These companies traditionally move last, but they move fastest and they move the furthest. And so the first boot camp that we did about 90 days ago, the reasons why you own gold and how you own physical gold. Extremely well-timed and a great boot camp. This boot camp will talk about the leadership change from physical gold to the highest quality gold stocks. Again, beautifully timed. And the last boot camp, we'll talk about when the baton changes one more time from the highest quality gold companies to the rest of the gold. I think a couple things need to be said about the boot camp. Three things, really, for people planning on attending. First of all, it's 8 hours long, and there's no polite way to say it. We're going to kick your ass over 8 hours. We're going to give you more information than you can absorb in 8 hours. He's been investing in high-quality gold stocks for 45 years. It's not like he's some Johnny-come-lately guy who flunked out of crypto and flunked out of pot stocks. This guy's made money where the rubber meets the road since the 70s in the gold equities market, a value investor who transitioned to gold. Superb human being who's been investing in gold equities almost as long as John Hathaway. A guy who started really in the penny dreadfuls and worked his way up to the best of the best, the experience that one gains after 50 years in a market. And then we have Joe Mazumdar, who is a really world-class geologist who can talk about the geology of world-class, high-quality deposits to help you, the investor, segregate between the good, the bad, and the ugly, because you're going to be confronted with all of it. The last thing I'll say is, like all of our investor education products, if you think for any reason after 8 hours of intensive programming that I didn't earn the $99 fee that I'm going to charge you, I'll give you your money back. This is a riskless financial transaction. There is no other purveyor of investor education that I know of that offers a full unconditional money-back guarantee. To get your money's worth, you have to come and pay attention. Don't be petting the cat. Play the tape once or twice. Then attend the discussion groups at the Rule Classroom and compare notes with other attendees to the boot camp. The ability to access the notes of 12 or 13 other people is way better than relying on your own notes. So it's important. It's designed as a total immersive experience, and it's designed to make you not a little money. It's designed to make you a lot of money.
Rick Rule exposes that, despite the Fed's and government's efforts to push interest rates down, rising long-term yields suggest they may be losing control, similar to the bond vigilante era of the Clinton years. The gold price isn't just reacting to interest rates and the growing gap between the real loss of purchasing power and returns on savings. While official inflation may be 2.5%, actual cost of living increases are closer to 7.5 to 8%, meaning that savers are losing around 3% annually. Historically, this loss of real value in fiat currency drives gold prices higher, which is likely to continue. Moreover, John Williams of ShadowStats argues inflation is higher than official CPI figures suggest. CPI excludes significant costs like taxes, which comprise much of living expenses. Considering rising costs, energy, groceries, healthcare, rent, and interest rates, since 2000, it's unrealistic to believe inflation has only been 2.5% annually. The real decline in purchasing power is likely much greater. Comparing this actual rate of dollar decline to returns from safe investments like 10-year treasuries reveals a gap, and it's this gap that historically drives gold prices higher. Now, let's get back to the interview.
If you look at the fact that the Congress and the executive and the Fed are all trying to jawbone interest rates lower, and they're adding liquidity on the near end of the yield curve, but the long end of the yield curve is still moving up, that tells you that perhaps like the Clinton years, the bond vigilantes are taking control of the interest rate from the Fed, which is to say the Fed is losing control of the long part of the yield. If that happens, your suggestion with regards to the Fed funds rate, what would be fascinating, and I don't know how to do it, Steve, is to overlay on this chart not the CPI stated rate of inflation, but some sort of chart that maps the deterioration in the purchasing power of the U.S. dollar relative to the interest rate. Because I suspect that the response you've seen in the gold price isn't merely interest rate sensitive, but rather is sensitive to the delta between the deterioration in the purchasing power of the U.S. dollar and the U.S. dollar return on capital employed in savings. Although the CPI says that the rate of deterioration of the dollar is 2.5% a year, when I look at the basket of goods and services that I buy, Steve, it occurs to me that the deterioration of the purchasing power of my savings relative to the goods and services I buy would suggest that the purchasing power of the U.S. dollar is declining by 7.5% or 8% a year. If the Fed funds rate, which is what determines deposit interest rates and the 10-year Treasury rate, is at 4.3%, and the deterioration of my purchasing power is at 7.5%, I'm losing 3% a year. And what traditionally has moved the gold price, and I'm talking about for 1,000 years, is investors' perception that fiat currency denominated instruments are costing them real purchasing power. If I'm right, and we have a 300 or 350 basis point 3 to 3.5% real difference between the deterioration of the purchasing power of the currency and the interest rate available on so-called risk-free savings, I think gold continues to do very well. And I think that your chart in that case is prophecy. No, I mean, John Williams at Shadow Stats has a different definition of inflation.
Yeah.
Perhaps you could average the Shadow Stats rate and get a rate that's closer to the truth.
Okay.
The CPI, among other things, doesn't measure tax, and it's the largest cost of living for most Americans. The idea that you construct a cost of living index that doesn't include 35% of the economy seems very strange to me. But even if you leave tax out of it, if I look at the period, my memory is not as good as it used to be, Steve, but if I look at the period 2000 to 2025, and I look at what's happened to energy prices, gasoline prices, grocery prices, health insurance, health care, rent, mortgage interest, a reasonably accurate, not a totally accurate, but a reasonably accurate statistic for the deterioration of the purchasing power of the U.S. dollar, and then juxtapose that with a return on, and I probably personally wouldn't use the 10-year, the Fed funds rate. I'd probably use the 10-year Treasury rate because that's what's available to savers. It's the delta between those two that drives the gold price.
Gold's past performance and current macroeconomic conditions, especially persistent negative real interest rates and underallocation in portfolios, suggest its upward trend may continue. As inflation quietly erodes the dollar's value more than official metrics admit, gold remains a compelling hedge and opportunity for long-term investors. The shift from bullion to quality gold stocks marks a new phase in the bull market, making now a critical time for informed action. Are you allocating any portion of your portfolio to gold or gold-related assets? Do you believe official inflation numbers reflect your real cost of living increases? Share your thoughts in the comments below. We'd love to hear from you. If you found this helpful video, don't forget to give it a thumbs up and subscribe for more content. Thanks for being a part of our journey.